So this is a high-level overview of one of the Section B questions from the March-June sample paper for 2023. This question's on valuations and it's a three-part question. Looking at the requirements, most of the marks, the technical marks, are related to the calculations. So in part B, we have to do something with the numbers, and in part C, we have to discuss the assumptions that we've made as we've done those calculations. So the core part of this question is handling some numbers, and that's where we're going to concentrate in this debrief. The first 5 marks ask us to discuss some views of a non-executive director, and we're just going to take these, stick them into the word processor, and we would make sure that we answered and we planned an answer for both parts of that question. And we'd make sure that as a discussion, we looked at the pros and cons of a view. So we had a balanced analysis, and that's going to help us pick up professional marks too. So in the first exhibit, we're given the basic scenario. So we are a company called OXWICK. We make fruit flavored soft drinks. We're thinking about buying Ludum, which is in green, which is in a similar business, produces a premium soft drink, and as a result is stocked by some retail outlets that don't stock our drink or our drinks. The views of the non-executive director are in red. The non-executive director believes the acquisition doesn't reduce risk and therefore we shouldn't go for it. And that's what we're going to start off by discussing. The idea that the acquisition isn't of any value because it doesn't reduce risk, and that we should be looking for acquisitions that do reduce risk. So the exhibit gives us 2 issues highlighted in red. We're not going to spend long on these. We're just going to concentrate mainly on the numbers. But the first issue, which I'll just make a note of in the scratch pad, is that an acquisition is only of value if it reduces risk. So we can discuss this issue. And you know, it's partly true, because if you can reduce risk, you increase the present value of your future cash flows. But lots of acquisitions will increase value by increasing future cash flows, and that would allow you to briefly discuss synergy, types of synergy, and ideally types of synergy that relate here. And then at the bottom of the screen, acquiring companies with different product streams, and we could talk about the logic of doing that, and the idea that our shareholders can diversify risks themselves. So perhaps this isn't that valuable. And suppliers, well, buying a supplier could be quite useful if supply is in short, if some ingredients are in short supply, it can help security. On the other hand, if you've got many suppliers, you can play them off against each other and sometimes get better prices. So look, it's a 5-mark question. We're not going to be writing about this stuff in detail, but that's some of the themes you could look at. Now let's have a look at part B. In part B, we have to estimate the equity value of combining the 2 companies. So this is a post-acquisition value. And then we have to say whether OXWICK gains from the acquisition, and whether it gains by the 15% mentioned in the second requirement right at the bottom of the screen. So that's going to be our yardstick. So part B mainly relies on the details in Exhibit 2, and I've highlighted the key points in blue. If we're doing a post-acquisition valuation, we would often expect to do this using cash flows. So we've got some cash flows, they're mentioned in the second section, and it will allow us to come up with a valuation using, we're told at the bottom of the screen, just here, a cost of capital of 12%. Now I'm going to assume that that cost of capital is a weighted average cost of capital. So what I'm going to be doing is taking the cash flows, working out their present value, and then using the debt to equity proportions that I'm given at the bottom of the screen, I'm going to take the valuation of all of the cash flows, and then 80% of that will represent equity. And that's going to form the heart of my analysis. So let's show some of the numbers here. It makes sense to start off by ascertaining the values of OXWICK and Ludham before the acquisition, because that's our benchmark. And the question tells us that OXWICK has 200 million shares worth 1152. So multiplying those two together gives 2304. Ludham's data is given in terms of their earnings. So their earnings currently are 52 million. And so we're going to value those earnings using a PE ratio, as we're told to in the question, reduced by 40%, as we're told to in the question. So we need the PE ratio of OXWICK, and to work that out, I need the earnings per share. The earnings per share is calculated by taking the earnings figure given in the question and dividing by 200 million shares. That then gives me a PE ratio of 18, and I can take 40% off that to give 10.8. So the value of Ludham is then 561.6, calculated as 52 earnings times 10.8 PE ratio. So that is my yardstick. Now I can move on to value post-acquisition, and the question basically gives me the cash flows starting from 270 in the first year, increasing at 12%, and then 10%, and then 7%. And the extra investment starts at 28, and then is based on post-tax cash flows, and is 80% of the change in the post-tax cash flow. And once I've got that, I can copy it over. The total free cash flows are therefore calculated in years 1 to 4. In year 5, I'm told that the cash flow will grow by 5% from year 4, and there'll be no extra investment required. So all that's really remaining for me here is to calculate the cash flows after time 5, and to do that I need to use an annuity factor, which is 1 over the cost of capital, 12%, minus the growth rate of 5%, and multiplying the cash flow by that annuity gives me the value of the cash flows after time 5, valued as if we were at time 4. So I've got to use the time 4 discount factor to bring them back to a present value. So the present value is 373.721 multiplied by the annuity factor multiplied by the time 4 discount factor. Adding everything up gives me a valuation of debt and equity. And so to complete this, I'm going to deduct 20% debt, and that's going to give me the value of equity. Now the question tells me to assume that I pay 15% premium to Ludham. So Ludham is worth, we think, 561.6. So the premium is going to be that amount multiplied by 15%. And subtracting that means that OXWICK's current shareholders will have wealth of 2767.055. So comparing that to their wealth to start with and subtracting 1, that gives me a gain of 20%, which is above the 15% that they also require. So those are the calculations, and that would allow me to conclude that we will fulfill the expected shareholder requirement, but only on the basis of the assumptions that we've made. And so for the final 5 marks, discuss the assumptions made. And the key point here is don't just list them, but obviously listing them is a starting point. So let's do that, but we need to go beyond that. Okay, so here are 4 assumptions, and I'm sure there are more. With each of them, what we've got to do is explain them and their importance or impact. So the PE ratio used to value Ludham is a 40% discount to our P ratio, but Ludham's got static profits, so perhaps that's quite generous. Now, if we have paid more than Ludham's worth, then we've overestimated what value remains to our shareholders after the acquisition. We've done a cash flow valuation. Presumably that includes some synergy. How much? We don't know. Is it optimistic? Again, we don't know. And if we've exaggerated those cash flows, then we're exaggerating the value coming through to our shareholders. After time 4, we've assumed 5% growth forever. That seems optimistic, especially for a reasonably mature business. If that is optimistic, again, we've overestimated the value to our shareholders. No investment after time 4 is unusual when we're forecasting growth. And again, it looks like that will be exaggerating the value of the company post-acquisition. And I'm going to get a mark or so, maybe a little bit more, for discussing each of those. And maybe I could also look at something like the cost of capital if I'm looking to pick up the 5th mark, and explain that if that cost of capital is too high, then that will be depressing the value of the company post-acquisition. So with each of the assumptions, it's a brief discussion that goes beyond simply listing what the assumption is. Finally, we've got the professional marks, and we're told what they are, but they're meant to be natural, just flowing from a good technical answer. So the analysis and evaluation marks are about using the data to determine suitable calculations, and then using those numbers to say something sensible, to make a sensible discussion or conclusion. And that's what you're naturally doing in part B. Skepticism is about challenging information, methods, assumptions, should flow naturally from part C, and also in a critical discussion of the non-executive director's views in part. And finally, commercial acumen, making practical points, sometimes by making reference to a real-world example. And that completes this short overview of this question.